This is the Investor Connect Fundraise Launch Program. I'm Hall T. Martin, the host of the show in which we take questions from startups and investors on startup fundraising topics. I hope you enjoy this episode. Thanks for joining us today for our TEN Fundraise Launch Program. This is designed to help those who are getting ready to raise a fund round. And we're here to help with that. We have templates, we have tools, we have eGuides, we have advice, and we also have a short presentation. We'll kick off the session, take about 10 minutes to walk through. So if you're putting a pitch deck together, this is for you. And if you already have put a pitch deck together, this is for you to check and see if you have all the slides in there that you need for what you're doing. As we go forward, if you want to go ahead and post potential questions in the chat box, like I say, this will only take 10 minutes. We can go further for the rest of the hour if you need to answer anybody's questions. But put your questions in there as we go, and then we'll answer them in the order in which they come in. So with that, let's go ahead and kick off. I'm Hall Martin with TEN Capital. I founded this company in 2009 under the name Texas Entrepreneurs Network, and we're here to help startups raise and funding and connect with investors. And one of the key ways to connect with investors is to have a good pitch deck put together that provides context, tells a story, and convinces the investor you have it together. So with that, let's go ahead and look into it. In your pitch deck, there's basically one slide for each section of the business. It's 12 to 15 slides in most cases. You don't need 40 or 50 slides. Investors can't take in that much information in one sitting anyway. And so the pitch deck is basically your executive summary. It's basically your business plan in a nutshell. And the key thing to remember is this: the deck is not your presentation. You are the presentation. The deck is there to help you tell the story with key information. So if you're putting on the slides everything you're saying word for word, well, you're duplicating. You shouldn't have to put everything on the slide that you're saying because you're already saying it, and so forth. The other thing you want to make clear of is that the deck needs to be visually compelling. If you can say something with a picture, image, graph, chart, or whatever instead of words, then do so. It really helps communicate the message a lot more clearly than if you put everything in text words on the screen itself. So we'll go to the next slide here. And so on your first slide, put up there your logo, your company name, and your tagline. Your tagline is your mission, your mantra. It's what you do in 5 words or less. It's something that says something about your business. It's important to start telling people what you do in different ways. And so make sure you put this up there in big, bold letters and fonts so people can see it from a distance. In Zoom calls, yes, we're all right up close to it, but in other places, we're not. So next slide up is your company description. Here, what you're doing is introducing your company, and in a few words, you're trying to explain what your business does, for whom, and why. And the key here is to start giving context about what area you're working in, what market you're working in, what problem you're solving, and who are you helping. I find as an investor, it's very hard to understand a pitch deck or deal with it until I know what they do, specifically what sector, segment, product, problem. When I have that, then everything else starts to make sense and fit in as we go forward. So you want to put that together in a short format as well. Next one up is let's talk about the problem you solve specifically. Start putting in there information about what is this problem and why it needs to be solved and so forth. And it's important to make clear that this is a big problem. You're solving something that costs people a lot of dollars or a lot of time, and you're there to help reduce it. Solving somebody's problem by only a few percent, unless it's a very, very big problem, is really not going to be compelling. You have to be making a significant impact into that as well. So talk about the problem you're solving there and identify the pain that the customer is feeling in what they're doing there. The next slide is your solution. And here, this is often about your technology or your approach or how you're going to be bringing it to the table. And this is one of the most important slides because this is really your intellectual property. This is your value proposition. This is what you're bringing to the table. So you want to spend a little bit of time in figuring out what that is and how to explain it to people in a short format word. And so what to make clear of is that this is a business-worthy solution, and you've got a solution for the problem that they have there. And then the next slide, and this is the one that's most often missed in decks, is what exactly is your product? In 5 words or less, can you tell me what your product is? And can you put a picture up there? If it's a mobile app, show a mobile phone with a screen of the app. If it's an enterprise software, show a picture of that as well with the screen to show something about what information you're taking in and working with on there. The key is you have to make clear what is the product itself so people get a sense of what it is, how it works, and how people use it. And if you can put a picture up there, I find that that communicates a lot right away. So now we know what we have and where we are going with it as well. Next up is your value proposition. Here you want to start going into the more details of your solution and start talking about what are the benefits of using this product or solution and what the customer gets from it. And then make a clear, concise, focused presentation. Many companies have multiple products and ancillary solutions and so forth, but in these decks, you want to always focus on the core. And then that's because people have to understand the core of it before they can get to the variations and the other things that you may be offering. So always focus on the core information. In this case, focus on the core value proposition. Are you saving them time? Are you saving them money? Are you saving them reputation? What are we actually helping them with that they want? So they want this solution that we're offering out there. And next up is you start talking about how your business works. And what you want to do here is make clear to people that we've got a process for how the business works. In some cases, it's not just an app or a piece of software. It's a full process. It's a service. It's something that they give us information. We put it in a database. We analyze it. We give them the solution back. And you want to start breaking down what you're doing so people understand exactly what is going on in a more detailed way. The rule of pitching here is if you don't mention it, it doesn't exist. So if you don't make clear what your process is, people may not fully grasp all the work that you're really doing for the price that you're charging. So it's important to do that as well. So the next one is to talk about your go-to-market plan. How are we going to get into the market? What channel are we going to use? What channel are we going to use to generate leads? And where are we going to find our initial customers? The worst thing you can say is we've got a very large market here and we're going to take 1% of it. The problem with that is it doesn't tell the investor anything about how you're going to go after that market. It doesn't tell them where you're going to start, how you're going to proceed. And it's very important to give a very good specifics about it. An ideal way is to say, here are 20 initial customers we're going to go talk to. Oh, by the way, we've already talked to them and they love what we're doing and they're ready to buy. This is the kind of thing that investors really get excited about because it shows you're in tune with the market and you know how to get into it. Many of these markets are very large. You can start in many different ways, and the investors trying to figure out what is your approach to that market as well. And then the next one is the market size. And what we want to do here on the market size is to showcase the market in 3 dimensions. One, what is the total available market? If everybody in the world could use it, how big would that market be? And this needs to be in the multiple billions of dollars. Next is the serviceable market. This is the market that you're actually going after, and it also needs to be a big number, but it's going to be much smaller because it's going to be the target that goes around what you're trying to do in this time frame. And then the third is your beachhead market. And the purpose of this is to showcase we know where we're going to start. We know who the first 20 customers are. And there's a reason why we're going after this segment. It's easier to penetrate, it has less competition. We have better connections. It could be many reasons why you pick it, but you want to show how you've got an entry into the marketplace and how you're going to use that to get into the rest of the market as well. So show the size of your market, and if you can show growth rates and some other detail, that's great too. But these are the 3 things investors are going to be looking for. Next up is the competition. You don't see competition slides as much as you did before, but I think it's still important to put in there that you recognize there is competition out there, and you have a chart or graph or table or something that shows who the competitors are. And I find one reason this is a very useful tool is as an investor, I learn more about what segment of the market you're going into by the list of competitors than I do by the market slide we just looked at. The market slide is just to say it's a big market. This slide actually tells you which market you're going after. And in some senses, for many investors, the competition validates the market. If there are other people going after it, there's money there to be made. If no one's going after it, then there's no money to be made. So you find the competition slide is an important one to put in there. Don't leave it out because investors are going to be afraid of competition. Many look at competition as a great validator, but then show how you're better than the competition. What figures of merit are you using to say, hey, we're better than what these other guys are doing? The next slide is the traction slide. This is what you have going so far. What kind of audience are you building? What kind of engagement are you getting? What kind of revenue traction are we seeing? And whatever you have, it's important to put up there that you're making progress with the customers. And so traction slides are very important. Even in the early stages, you want to show that you are out there engaging with customers and you're succeeding at some level with it. Next one is slide revenue. This is where we actually start getting into how much are we bringing in the way of revenue, costs, and profits. Just 3 lines. This is the financial slide where people often just cut and paste a big block of cells from their Excel spreadsheet into the slide. Problem with that is it's almost unreadable when it gets that much up there. About as much as you can put up there for financial data is about 3 rows of numbers, and then add a graph, either a bar chart or line chart that visualizes those 3 numbers to show where you're going. And the purpose of this is to do, say, this year, last year, this year, and the next 3 years, so you have a 5-year window on it. The purpose is to show that you're showcasing what you think the growth rate is going to be based on the fundraise, when you're going to cash flow positive, what slope are we putting on that curve, and where have we been before, just to give it context. So do last year, this year, and next 3 years gives you a 5-year window, and that should give you some bearing around what you're actually proposing is going to happen with the funds raised there as well. And next one up is many people have a vision around what their product is going to do, but it may not be all the way there today. We're just now starting. So put out a platform roadmap. What do you think the product will be in the coming years? I meet many entrepreneurs who are building a service company today with the idea that they're going to collect data and monetize the data in a few years, and then they're going to turn it into an AI system a year after that. Well, showcase that service, data, AI to show that you're on the track to get an AI business out of it, because you'll find your valuation goes up by an order of magnitude for each of those steps going forward. And if you plan to do that, go ahead and telegraph that as a visionary statement to say where you're going to be with it. The next slide is your team slide. This is where you want to highlight the founders and the team. And if you have advisors, put them on there as well. And the key is to put their name, their title, and any projects or companies they work with that are relevant to this industry. Keywords will shine a lot bigger than detailed bios or whatever. Nobody can read the detailed bios. So just put the big words up there that showcase that you have an experienced team and everyone has industry knowledge is what investors are looking for in this case. Next slide up is if you have a board of directors, go ahead, or board of advisors, go ahead and put them up there. If you're very early, go ahead and combine it with the previous slide just to make the team look bigger. Advisors are often brought in to fill gaps on the team that aren't there. There's no one for finance, so let's bring in an advisor who can stand in for the finance role. In the early days, we need a little bit, but we don't need a full-time person for it. Advisor is a good solution for that as well. And then the next one is your fundraise slide. And what you want to do here is actually show how much you're raising, how much has been raised so far for the business, if any, and then how much has been invested in the previous business before this round. So if I'm raising $1 million, I have 500K raised so far. That means I'm halfway to my goal. And if in previous rounds, I have $2 million into the business, that gives the investor some idea of how much investments has gone in already and at what stage of the process you should be at this point. And then the last slide is the exit strategy slide. And this is, what do you expect the business to become? Are you planning to go IPO, planning to go public with a SPAC, planning to keep the business for 10 years? What do you think the business will become? And how do you think you'll be able to pay back the investors? And you're looking at similar comps or exits in the industry related to yours to show people that businesses buy the startups like the one you're building, and show the vision that we are going to be like them as well. So you want to showcase that you have the exit in mind, even though we really can't get too detailed about it at this point. So those are the major slides to put in it. We have a template with this. If you would like to have it, just send us a note in the chat box and we'll send you the template that you can use. The key thing I always tell people about a slide deck, the way you want to approach this is take the template. On each slide, go through and write out on the slide the 3 messages you have for each of those slides. Before you sit down and start building the slides, think about what you want to say. What is your message? What is your content? If I'm putting metrics in there, which 3 metrics do I want to use? Once you have that, then go back through and start wordsmithing the bullet points into graphs, charts, and other things so it looks good. And then practice it, walk through it, and do a dry run through the presentation and see if it flows. If it doesn't flow, you may have to move some slides around so your story carries all the way through. So the key is to figure out what you want to say and then start to build that in there as well.
Hi, I have a question about the valuation, because that is mostly, I think, a critical point that investors would like to talk about. And for example, we calculated a discounted cash flow model based on an average what our peers are making in the market, because we do not have revenue at this point. And that was highly controversially seen by some of the investors we talked to. And is there any better approach that we could take?
Sure. Unfortunately, at the very early stage, especially pre-revenue, you'll find the traditional valuation metrics such as discounted cash flows, book value, asset value, they don't really apply because you don't have cash flows yet. And forecasted cash flows are just very hard to get everyone to agree upon. And so in the early stage, we're using other valuation metrics to go after it. The 2 that we'd like to focus on is, number 1, what we call comparables. And what you want to do is look at similar companies like you were doing with your example there, but instead of looking at their cash flows, look at their valuation. Look at where they are today and what valuation they're getting, and then work back from that to where they were when they were your stage, when they were pre-revenue, what valuation were they using? What were they doing at that stage? So you want to look at similar companies, but you can't use a later stage company that's similar to yours valuation. You have to use the valuation they used when they were at your stage. Now, another approach to this is what I call the rule of 4. The rule of 4 valuation says give yourself $1 million of valuation for each of 4 things: sales, team, product, and fundraise. And if you have sales fully in place and everything's working and revenue's coming in, give yourself $1 million. If you have the product, it's fully in place, everything's working, give yourself $1 million. If, on the other hand, your product is not fully in place, it's not shipping, it's not final, but maybe it's in beta, well, then give yourself a portion of it, say $500K. And then look at the team. If you have all the positions covered for the executive team and everyone's in place, $1 million. Well, maybe you only have 2 out of the 3 people, so let's give ourselves $600,000 for the team. And then the last one is intellectual property. If you have everything filed and awarded as patents and technology and intellectual property, well, then give yourself $1 million. If you filed 3 provisional patents, then let's give ourselves, say, $250,000. So the idea is you're articulating the values that are in the business today, and you're putting a value on it dollar-wise, and then you add up all 4 to get your valuation. Now, in today's market, the market's at a very high place, and so what you'll find is that you're sometimes past that rule of 4, and I call that delta the speculation factor. If I add up my 4 numbers and I come out with $3 million, but I want to put a $5 million valuation on it, then $3 million are the value in the business and $2 million is a speculation. And now when you talk to an investor, you want to talk about what's in the business today, and you want to highlight what values are there. If you don't mention the team, you don't get the credit for it. I will say, no matter what number you put on the table, investors will challenge it. So you must always be able to defend it. And to talk about how similar companies at your stage got that valuation, to use a rule of 4 where you identify the specific things in the business, the team is together, the product is working, the intellectual property is filed, it starts to make a more defensible valuation itself. And finally, with valuation, it's a negotiation, not a formula. Yes, we use formulas to come up with numbers, but in the end, it is a back and forth. It is a compromise. That helps when you go into a discussion with an investor mentally. If you realize this is a negotiation, it's not everybody's going to agree, but we will come to compromise into a solution at some point. It will take some time and you will get there. The key is to actually have hard value adds in the business to put on the table rather than I just think I'm worth it, because that ladder is really not very compelling. So those are my suggestions. What questions did you have for me, Jake?
That was pretty good. Thank you. And yeah, in fact, we are in a situation right now where we probably need to also look at the amount of funding that we require to fulfill all our milestones that we have set for our company, especially in terms of marketing expenditures. Marketing a brand new product is very expensive. And if an investor gives you $1 million and you do the kind of marketing that we are envisioning, then we're burning through that $1 million in 1 year. And so it's really here the difficulty to agree to, with an investor, to agree in some sort about what we need. What we need, we think, is at least $3 million, and then come up with a valuation that would actually allow to raise $3 million even before we have revenue. And that's difficult. But yeah, thank you for the inputs. I'll try to work it out a bit better.
Sure. So on fundraising, what we always talk about is milestoning out the fundraise. Typically, if you're going to market without a product or it's even a pre-seed product, you're raising around 250 or 500. If you're going into the market with a product, you're raising 500 to 750. And partly because your valuation is going to be the lowest it will ever be up front. And so you want to think about raising the minimum amount you need to get to the next level, not the maximum amount, because the more you raise at this early stage, the more equity you're giving away. And so you want to scale back features, marketing, et cetera, to do just the very basic things that you need in order to stand up the product, stand up the customers, and get the thing going. And then raise the majority of it on the next or third round when your valuation starts to go up. As you add product, team, and revenue to the process, your valuation takes stair-step functions up. And that's where you want to raise the majority of it. So mostly what you want to be thinking about is how much can I do with 250, 500K on the first round to get out there. And then when my valuation jumps up, now I can then start to use discounted cash flows. Now I can use comps from other companies that are growing just like I am. And the valuations will be much higher and it'll be a lot easier to raise 750, $1 million, and then on up after that because you've not taken a big hit in equity up front itself. So consider milestoning it out and thinking about minimizing funding as opposed to maximizing funding. Also because you'll spend a lot more time raising funding if you set the goal at $1 million rather than 500. Set at 500, you'll spend less time on that and more time on the business.
Okay, well, thank you. That makes good sense. Appreciate it.
I have a question regarding the deck and keeping it visually appealing.
Sure.
What do you think about the use of video? And I ask because we've got a very simple 90-second video that thoroughly explains our technology and the problem. It's very effective. We've got a fairly challenging scientific chemical process that we utilize as our product, but it's very difficult to explain quickly, and this video does a nice job. I just didn't know if it would be a distraction and nobody's going to look at it, or if that's a better way to go about it.
Right. I find videos work well if you're using it as part of your presentation. You're showing the video, and instead of the video explaining, you're talking over it as it's going through. And so since it's your presentation, you're going through the slides and you're going through the video gives you the visuals, but you turn off the volume, but you actually do the voiceover to explain what's working. And then that kind of fits into the format of the slides. If you stop talking and turn on the video, and I've seen guys go over and get a cup of coffee while the video is playing, it just doesn't seem like we're doing the same thing anymore. It was a pitch, but now we're watching TV. Now we're going back to a pitch, and it just doesn't fit in very well. Most detailed videos also work better in advance of the meeting. Send them the video to watch it before they come, or to send it as a follow-up to watch afterwards, to give yourself something to give them to do before and after the presentation is another option if you have that. So I like videos. I think the technology is there now. I used to tell people, do not put videos up there, because we spent half their airtime just jacking with the encoders and trying to get the mic to work, and it was just a real mess. Today, if it's all online with Zoom, video is really not an issue anymore. But I do think the format is off there. It really should be you driving the pitch, not delegating it over to the video and back. So those are just some thoughts there about how videos might or may not work for you there.
I have a quick question for you. This is specific work with medical device companies. We're trying to raise money for that side. So it's kind of a little different than the tech based, but we've been hearing some conflicting information recently. And I don't know if you know specifically with investors. Ours is a respiratory device. And of course, a lot of people on their minds right now is COVID. When they hear respiratory, they're thinking COVID. Ours does address that, but we don't want to be short-sighted and only talk about COVID and of course, limit ourselves, but because it's much, further reaching than that. Do you think there's any risk of just, because we've heard like, oh, well, you should use it, while we have a chance, people are thinking about COVID, we should just use that and push the COVID aspect to get money, to get investment, to get towards FDA clearance where we're trying to reach? Or we've heard other side where investors they hear COVID and they turn their ears off and they're like, nope, I don't want to hear it. It's short-sighted. This is going to go away in a year or two and we're going to move on. Do you have any ideas with that of debacle?
Well, typically you want the platform-based product, a product that does more than just one thing. So the idea is I would list COVID, and then I would list the other things that are up there. I'd put COVID first, but I put the other things that we're doing. If you're going after, reimbursement codes that are specific to COVID, you have to think about that. If you're going after codes that are more encompassing and include COVID, that seemed like the better option, because now you get reimbursement for any respiratory, not just COVID. So it seemed like that might come in at the reimbursement code level itself. And so if you're designing the product, it seemed like you would, build a platform. And if there's the ability to do more than just COVID, I would do those. I'd make it a broader product myself. But in all the slides, I would put up there, number one, COVID's a big market. We're going after COVID, and that's part of it, but not take myself out of the ability to do other respiratory illnesses as well, and see where the real trade-offs are there. Like I say, product design and then reimbursement codes are the two I'm thinking of. Are there any other trade-offs you're seeing?
Yeah, I mean, that's definitely the two big things. With reimbursement is definitely a huge market.
Right. I would go after the bigger market. But in the marketing of it, you can always emphasize COVID enough to make clear, COVID's going to be a big driver. It's going to be around for more than a year, as we see with the variants. Some say it's up to 7 years. So I would get some data showcasing that COVID is really not over. We all thought that in July, but nobody's thinking that anymore. It's really going to be around for a while with variants. And so there'll be plenty of time to go do both. In this case, is my coaching.
Another question we had was, what is the best means to find and approach the right VC investors, especially stage and industry specific, considering the amount of VCs and investors that are out there?
So what was the best way to approach VCs?
What was the best way to find and approach the right VC investors for you?
Okay. So step one is identify the right investors, research the investors and figure out who's in your revenue sector stage and criteria, who's funding deals that you think are relevant to what you're doing. So you're in your sweet spot. Half the deals that come to a VC are outside their criteria, do not meet their investment thesis. So if you research it, half of them go away right there because they're investing in something else. Second is talk to their portfolio companies and then see if they will give you a recommendation. How was it working with that VC? What did they help you with? How did it go? And then when you find a good answer to that, well, then the next question is, can you, Mr. Portfolio Company, help make an introduction for me? And see if they will do that. And that's the best way to reach a VC is through a trusted connection. And a portfolio of a VC is a trusted connection. And at some point in doing diligence on a VC, you want to talk to the portfolios anyway. So you want to be reaching out to those guys sooner rather than later to find out if it was a good thing and if it matches what you want, how much support you want, how much funding you want, how much follow-up funding do you want, what kind of expertise you want. All of those are the questions you want to ask that portfolio to see how much they delivered and are they the right fit. And then next is to focus in on those groups. It's better to find 10 of those and focus on them for a period of time rather than 100 where half of them don't fit the criteria and they don't work for you. So that's the way you do it, is to know who you want to go talk to first and then qualify them and then get the introduction from those who are helping you qualify it. Are there any other questions at this point?
Yeah, sure. So this is a question that I've never been able to get an answer to. So we have a few larger customer, one particularly large, who is considering investing in the company, but they also want to be a customer. And part of the discussion is, if they invest, can they invest at a more advantageous valuation if they get a discount on, or severe discount on the product, on the platform? Would you advise against that? Is this a artificial valuation then? Is it frowned upon? Is it even legal? Does that make sense?
Right. So if the customer is really strategic, if they can really add value by having their name on the cap table and they can open doors for other people. There are some corporate VCs that are that way. They really make a big difference. It's worth doing. Then it's worth doing. If they're not, then what I would do is, and this is what happens with many of these company investments, is that the investment kind of goes away and they just start buying the product. And now they become a customer reference instead of a venture capital reference. And so it just depends on how much value you really put on having them on your cap table. If you really need a lead investor to close other investors, it may be worth it. If they have a big name, it may be worth it. If they don't have a big name and they're really not adding any more value than dollars, then I would just shift it over to, well, let's just sell you more product. We'll give you a discount, but not as deep as you were thinking about, but we'll give you a little bit of a discount. So you're good, but we want you to be a good customer reference in this case and not lose the revenue in this case. Because that is the challenge with taking an investment from a customer, is that they want to trade off the price of the product for the investment. And that's usually not a good trade-off. Usually you need all the revenue you can get from that customer in order to grow the business. Otherwise, you're struggling to make the next customer work because you didn't get enough revenue from the last customer. So I look harder at the value that investment brings to you beyond just the dollars.
How about follow-up investors? Could this be problematic for follow-up investors who look at that initial investment and say, wait a minute, that valuation doesn't make sense, even though that big company invested in your company?
Right. Well, they have to have a meaningful valuation coming in. I think we were talking about taking discounts on the product you were selling, but they were going to come in at a standard valuation. If they're trying to get a lower valuation because they're a customer,
no, the other way around. They would get a high. They would be okay investing on the higher valuation if they got a discount on the product.
And you have to look at how much of a discount that is. If that's too steep, then I'm looking at more than just the valuation. I'm looking at what that investment brings me with reputation, follow-on funding, other investors, that type of thing. And if they really have that, if that's going to really help drive other investors to come in, then I would consider it. In most cases, that's really not the case. They don't have a big name. They don't have a big reputation. They just trying to make a buck. Well, then no, we don't want to do that. You're going to give yourself problems with other investors, and it could put the cap table in a funny place, and we don't want to do that as well. Too much dilution early on is a big problem with some of these deals.
What would you consider is a maximum equity share to give away in a first investment round?
You want to be in the 20 to 25% range. If it's anything above 25%, then we're raising less money. We could just go down to the minimum. The first raise could be, the minimum you can raise in this world is $250K. If you do less than $250K, investors will question if you can really do anything. But you can do something with $250K, and you just take the absolute minimum amount of money, which is $250, if it's too far above 25% of the equity. And then you want to try to keep it in the 20-25% range going forward. And as you get higher, go down to 20. But that's the rule, is don't take, if the valuation is just not as good, well, then either walk away from the money or just take the bare minimum and go build something, and then come back 6 months later and try again with a different group of people, because now you've got more team, more product, and you're at a different place and more experience, maybe more connections. So that's what you want to do, is not get yourself diluted too much on the first round.
Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.